Hey everyone, let's jump right in. Today we are diving into a fast, highly practical, plain English explainer all about home buying math. If you're thinking about buying your first place, or maybe you're looking to remortgage, you probably already know that the numbers banks throw at you can feel like a totally foreign language. But honestly, understanding this math is the absolute most important thing you can do to protect your hard-earned money. So today we're going to decode those numbers, look at how the calculations actually work behind the scenes, and show you exactly how to escape one of the biggest, most expensive financial pitfalls out there.
So here is the big question. Are you falling into the term trap? It's something every single homebuyer needs to ask themselves before they sign on that dotted line. The banking industry honestly relies on complexity, but we're going to strip all of that away today. Okay, let's dive into this and look at the reality of how mortgages actually function.
Section 1. Decoding your monthly payment.
Right. Before we even think about browsing property listings or dreaming about that perfect open-plan kitchen, we have to understand the magic behind every single mortgage calculator, and that is amortization. Basically, it takes three simple inputs: your total loan amount, your interest rate, and your term, which just means the length of the loan. The formula then crunches those numbers to solve for one fixed monthly cost that pays off the whole shebang, plus interest in equal installments. But here's the kicker. That fixed payment isn't just split right down the middle between your loan and the bank's profit. Not even close. As you'll see from month one, an amortization schedule is set up so a massive chunk of your payment goes strictly to interest, and just a tiny little sliver goes toward the principal, the actual money you borrowed. Why? Because interest is always charged on your remaining balance, and your balance is obviously highest on day one, so your early payments are incredibly heavily weighted toward paying the bank's profit. That right there is exactly why you can pay a mortgage for literally years and feel like your actual loan balance has barely moved at all.
Section 2. The 28/36 Affordability Rule.
Okay, so knowing how a loan works is step one, but step two is finding your true budget. The 28/36 rule is what lenders and planners actually use, and it gives you two distinct limits. First, the 28% front-end ratio. This means your monthly housing cost should never exceed 28% of your gross monthly income. But pay close attention to what's in that bucket. It is not just the mortgage. It includes property taxes and insurance too. Then we have the 36% back-end ratio. This one means all of your monthly debt combined, so that housing bucket plus any student loans, credit cards, or car finance needs to stay at or below 36% of your gross income.
Let's make this math concrete so it really makes sense. If you have a gross monthly income of £6,000, your 28% housing ceiling is exactly £1,680. That is your absolute hard limit. You don't walk into a bank and ask them what your maximum is. You take this £1,680, remember that it has to cover taxes and insurance, and you work backwards in your calculator to find a realistic loan amount that you can actually afford to carry.
Section 3. Beware the term trap. Now that we have our budgets sorted, we're entering the real centerpiece of this explainer. This is a costly illusion that catches millions of buyers totally off guard. We're looking at the exact same loan here, £250,000 at a 5% interest rate. If you go with a 15-year term, your monthly payment comes out to about £1,977. But if you stretch that out to a 30-year term, your monthly payment drops all the way down to about $1,342. Naturally, that lower monthly number feels fantastic for your cash flow. It feels like an amazing deal, right? But what is that lower monthly payment secretly costing you?
Well, it costs you £233,131 in pure interest. Just let that staggering six-figure number sink in for a second. That is the total interest paid over a 30-year term for a £250,000 loan. Think about that. You are essentially paying for your house and then buying the bank a second house just for the privilege of borrowing their money. No way around it, that is wild. So the really crucial point here is the massive interest jump as the term gets longer. For 15 years, the total interest is roughly £106,000. At 20 years, it jumps to £146,000. At 25 years, you're looking at £188,000, and at 30 years, you hit that staggering £233,131. Stretching your loan from 15 to 30 years literally means you pay more than double the interest for the exact same £250,000 loan. Keep in mind, nothing about the property changes, nothing about the loan amount changes. You are just paying a massive, massive premium for a longer term.
Section 4. The cheat code. The power of overpaying.
Okay, take a breath, don't panic, because there is a surprisingly simple way out, even if you're already locked into a longer mortgage. Because interest is always charged on your outstanding balance, every single extra pound you put toward the principal early on entirely wipes out all the future interest that pound would have generated over the decades. It's like a financial cheat code. If you have a £250,000 loan at 5% over 25 years, adding just £100 extra a month has a phenomenal impact. It quietly and powerfully rewrites the entire amortization schedule in your favor. That tiny £100 overpayment shortens the whole loan by roughly 3 years and saves you tens of thousands of pounds in interest. And remember, the earlier you start doing it, the more massive the effect.
Section 5. Run your own numbers. So the examples we've walked through today are definitely eye-opening. But to get this right, you really have to run your own specific numbers. And a quick warning, basic bank calculators rarely show you the full picture with taxes and insurance included. To get a true view, you can use toolstack's free mortgage calculator. It's completely free, requires absolutely zero sign-up, and it works in 15 different currencies. But the best part? It doesn't just give you a generic monthly payment, it actually shows you the full amortization schedule, including your total interest. You can literally type in an extra 50 or 100 pounds a month and instantly watch the schedule update to show exactly how many years and how much money you just saved yourself. It puts all the control entirely back in your hands.
Which brings us to our final thought for this explainer. Now that you know exactly how amortization works, you know the harsh reality of the term trap, and you've seen the incredible power of overpaying, will you just let the bank decide your term? Or are you going to rewrite the schedule in your favor? Head over to the calculator, plug your numbers in, and start taking real control of your financial future today. Thanks so much for joining me, and keep learning.